There we go. So welcome to virtual meetup. Like I was saying, we do have our two in-person meetups going again. We're keeping this one on the calendar for the time being. I have feeling attendance will drop off a little bit as the other ones ramp up, but I like having the virtual option, especially when we start getting into the colder months, or when we get into those months where it's just like ungodly hot out. So welcome everybody. Tonight's agenda, I'll tell you a little bit about who we are. I'll do a quick market update with some of the data that we pulled from MLS and Showtime. We'll open it up for networking. It's a small group, so it should go pretty quick. Have you guys introduce yourself, tell us what you're here for, see if there's anything we do to help you. And then I was planning to go over, we just closed on our first syndication yesterday, 132 unit in Lowell. We weren't able to talk a whole lot about it while we were working on it, just because we were under SEC guidelines. Now that we're closed, we can talk a little bit more freely about the property. So the next couple of meetups, the one in Nashua, the next one in Lowell, this virtual one, I do plan to have this one as a topic because now we can finally talk about it a little bit more openly. And I know there's been a lot of questions from people over the year it's taken us to get this one closed. Who am I? So my name's John. I'm a real estate agent. I house hacked a 3-family about 10 years ago. I've been an investor, ever since. We currently own 212 units as of yesterday. And so, I've been keeping track of the last couple of months in terms of how our unit count's been going. So, it's gone up quite a bit. And, the last closing was the 132 units in Lowell, which, kind of took it from 80 to 212. We're constantly buying things, selling things in today's market, right? There's a lot going on. If we have a small property that opens up in terms of like the tenant just leaves on their own, or we're able to get them out, we always kind of look at, should we sell it and roll the equity into a larger property, or are we happy keeping it? We've been shedding a lot of the condos and 2-families and smaller buildings, so that we can buy some of the larger buildings. I still like the 5s and the 6s, and we're looking for other big buildings if we come across any. How do we grow the portfolio in today's market? Just by taking massive action, right? So I talk about this a lot. We are always putting in offers. I'm walking 46 units on Friday. I'm sending an agent to walk 12 units at another part of the state at the same time that I'm walking the 46 units. I've got a schedule with a wholesaler in Lowell to walk 6 units on Saturday. I'm meeting someone at another property in Fitchburg on Thursday. So we're always kind of looking at stuff. I normally, when I look at a property, I normally submit an offer. It may not be at asking, it may not be, it may be significantly below asking, but normally when I walk a property, I normally submit some sort of an offer, whether it's verbal or written. I submit something that seems to make sense to me, put under contract if I can, and start due diligence. It doesn't always work out, but I always try to take a shot, right? We're walking a 27 unit, gut rehab in Fitchburg. The guy wants $700,000 for it. We're probably going to offer $450, but we're going to go walk it. We're going to shoot the shit. We're going to talk to him. We're going to build that network. And then at the end, we're just going to shoot our shot. He might tell us to screw off, but at the end of the day, we'll take that ability to meet him. And who knows, 2-3 months from now, going into the winter months, if he got other offers in the same ballpark, he may give us a call back. If I don't go out there, if I don't, present the offer to him, I'm never going to have the shot of getting that call back. We're always trying to move the ball forward. I've put a lot of things under contract that didn't close, but we've never lost a deposit. We've never lost any significant amount of, due diligence funds, which is just, doing it the right way. I think we had a couple other people come in. It's a smaller group than normal. I think the in-person meetups are great. We had quite a bit of attendance on Thursday, so we'll play these by ear. We've also had a few things under agreement that didn't close. This 132 unit building in Lowell, we've been working on it for well over a year. It finally closed yesterday. We've got a trailer on an acre of land in Littleton, New Hampshire, which we already got site engineering plans done, permits approved for a 6 condo development. And then when they did the title, they found out that the guy actually didn't own all the land. Some of the land was unowned. There was no record of ownership at all for the land at all, so that he had to, go through the process of trying to get ownership of the land. That may or may not close. It just all depends on, he thought he owned an acre of land. After we did the title search, he owned a half an acre of land, and the other half acre was unowned land, which I guess is a thing in New Hampshire. I don't know of any unowned land in Boston, but if anybody finds any, please let me know, and we'll figure it out. But I guess in northern New Hampshire, it's still a pretty common thing. We had 103 acres of land under agreement in Littleton, New Hampshire. That turned into a little bit of a shit show where we ended up in the newspaper and public hearings and everything else. It may still actually close, but I'm a skeptic. I think that one's kind of dead in the water at this point. We had a 26 unit in Keene under agreement. We started doing due diligence, and we found out that the income was a little bit less than we thought, and the expenses were a little bit more than we thought. And so it just squeezed our numbers a little bit too much. It being, an hour away from our closest building to Keene, New Hampshire, we just didn't feel comfortable, and we had to back out. Luckily, the buyer's agent that we knew pretty well was able to bring in a different buyer who had property, much closer, who was much more comfortable with it. So even though we weren't able to close, it wasn't a lost transaction. They were able to find a buyer. They were able to close. And so it worked out better than if we just looked at it and then said, no, I'm not sure, so I'm not going to submit an offer. It worked out better for everybody by submitting an offer that we ended up having to pull out. We also submitted an offer on a 170 unit portfolio in Central Mass. There were 5 offers. We came in second, so we were the first loser. Not too bad. But rumor is that there, might be some trouble in paradise with the first offer. So even though we lost, we are in a position to potentially take a swing at it, if something goes wrong with the first offer. Again, if we didn't put in that offer, if we found out that, we weren't going to win and just didn't do anything, there wouldn't be a potential to claw it back. Even though we put in a losing offer, it still has potential to turn into some fruit gained later on. My why, the reason why I do this, the reason why I got into real estate was to reach financial independence. I was in corporate finance for about 10 years, spent 3 hours on the bus to Boston one day, said I can't do this for the next 40 years. And so started getting into real estate. When we reached our lean financial independence number, I quit my corporate job. They walked me out, that day, because I wasn't going anywhere. I was retiring, and they didn't get that. And so that was my last day. Tonight, I'm not an agent. Think of me as, just an investor. We can talk a little bit more freely, but yeah, this is what I love to do. I probably work more hours now than I ever did when I was in the corporate world, but it doesn't feel like work, right? Like if you told me, in the corporate world that I'd hop on a Zoom call for 2 hours with, a bunch of my coworkers, like I would probably dread it. I was looking forward to this 2-hour Zoom call with you guys. So it's just a very different mindset, very different process. So even though I work more hours than I did before, it's that the hours are good. Does anybody have any questions for me? A lot of you know me already, but if anybody has any questions, feel free to interrupt at any time. I'm going to blow through some of this stuff just because, we're a small group, get to the meat and potatoes. So, we've got a pretty large team. Everybody's investor focused. Our mission is just to help as many people as possible. I care more about the relationships and the transactions. So a lot of times, the first transaction needs to go well, because most of our clients, they want to buy, multiple houses over a short period of time. We just have a very different business model than traditional brokerages. If the first transaction doesn't go well, you're not going to come back to us for the second or the third or the fourth. And I care more about, the third, the fourth, and the fifth than I do about the first one. So we just have a very different mindset. A lot of our agents, we talk more about the times that they tell, clients not to buy houses. It's okay to back out given that we got a bad inspection. It's okay to say no to this property, which I think is a little bit unusual, in the real estate world. But I could be mistaken. We did launch a property management company, which we're in the process of growing. Simplified Management manages our own units, and we haven't started marketing this publicly yet, but we're hoping now that the big project is behind us in terms of the stress of the closing, I'll have a little bit more time to dedicate to growing our management portfolio. MLS data. So I pull data, every month just to kind of go through and show you guys what's going on with the market. We have an agent on the team who's just like a data jockey. So he kind of pulls this. I'll run through this quickly. I mean, none of this data is surprising, right? So this is Boston, Massachusetts, multifamily data, going back to 2006 in terms of the average list price and the average price per square foot. You see it kind of bottom out in 2008, 2009, and then it just goes up and to the right. And it's quite a bit higher than it was back then. It's pretty much doubled in terms of the average list price and the average cost per square foot. But it's been a steady climb in Boston. And so none of it's kind of, not really surprising, but it's just interesting to see, how it's pretty much doubled since that timeline. A lot of the people who bought property, early on, they have a significant amount of equity. And so that's a little bit different than the 2008, 2009, because, the market's just been very good for the last 12 years. Days on market and average listings since 2019. So Boston got a little bit weird during COVID. People left Boston, so they went into Southern New Hampshire. We saw the number of listings stuck on market kind of spike during COVID because people were exiting the city. In January, the market kind of reset, and it seems to be trending much better now. But we did see some red warning signs during those, height of COVID months when the number of listings in Boston's were exponentially higher than we were expecting. The price per square foot and the sale price over the last, 2 years has stayed relatively flat in Boston. We see a little bit of a dip due to COVID going into 2021, but relatively constant at that, $1 million, $400 to $500 a square foot price. It did spike a little bit in 2019 and 2020, but it leveled off a bit and stayed pretty constant over the last couple of years. This is just Boston multifamily data. This is Lowell multifamily data. So again, we can see, up and to the right, property values doubled over the, the same timeline. Price per square foot, didn't quite double over the same timeline, but, very similar trends to what you saw in Boston. It went from $100 a square foot in 2008 to $200 a square foot, depending on when you hit that spike in 2021. Average list price went from, $200,000 in 2008, 2009. Now it's up above $400,000. So the multifamily market in Lowell, we've definitely seen prices go up quite a bit. And compared to, the last couple of years, it's just been ramping up. Days on market, listings, that's a pretty healthy graph. We didn't see nearly as much of a spike as we did, in Boston due to COVID. That's a pretty reasonable spike, right? Like it coincides, like it lines up with the spike that we had in 2019, just in 2020. So when you get into those summer months, you do get a spike in terms of the average days on market, just because you do have a lot of, new properties coming on. Properties get overpriced, they stick on the market. The interesting thing is looking at the blue line, right? The number of listings has been constantly low, and going into COVID, the number of listings were actually at an all-time low in the city of Lowell. And so even though the days on market were up, the number of listings on market were very down. And we paid very heavily attention to Lowell market during COVID just because it's our home office. And the problem is there's just a couple of multifamilies that were on the market that were insanely overpriced, which were driving that days on market up because they were double what they should have been, and they were just refusing to lower the price or remove them from market. And so with such low amount of inventory, that skewed those numbers. Price per square foot since 2019 and average listing, relatively constant over the last couple of years, which seems reasonable. And then this is Worcester. So we do quite a bit of Worcester in Worcester as well. The thing about Worcester is we've seen a lot of growth recently in the value in Worcester, but it didn't nearly do as much as Lowell did. Like if you look back at 2006, multifamilies are selling at like $300,000. They dropped way down during 2008, 2009, and now they just recently in the last 12 months gotten to the point where it's above where they were in 2006. It has officially doubled from where it was, when it bottomed out, more than doubled, but it took a lot longer for it to bounce back. There was a big drop in value in this market compared to some of the other markets. The average list price per square foot didn't like double itself, right? So it's up to $150 a square foot. I guess it did kind of bottom out at about $75 a square foot. So again, it did pretty much double from that standpoint. But if you look back, 2006, it was a little bit over $100 a square foot. So it just took a lot longer for Worcester to rebound in the multifamily market than some of the other ones. And that's led people to look at Worcester as a more affordable market. The price is a little bit lower, the cash on cash returns a little bit better. And looking at some of the other statistics, I mean, there's just more inventory in Worcester, right? So the average number of listings in Lowell were well below 25. The average number of listings in Worcester are quite a bit more. So more inventory, and it took longer for the prices to get where they were. Led a lot of people to look at Worcester as a potential market to invest into and grab some of that appreciation. Does anyone have any question about the data? I kind of like the data, but I did run through it quickly, just because, never know who has questions about it. Cool. The other side of the equation is like the buyer side. So this is showtime. This is the number of requests we get in terms of bookings. So looking at, this is the impact of COVID on a national level. And then we see the rest of the year kind of trends, 25% higher than what was happening going into the 2021. This yellow line is trending very closely to what we were seeing in 2019. We did get a question from Andrew. Are you seeing a dip in prices? I'm seeing price reductions and more days on market over the past month in Worcester. So I think we are starting to see a little bit, but again, I think it's the properties that were on market a long time. I think if you price something right in this market, regardless of where you are, you're going to get multiple offers. Right now, we're going to the summer months, so the amount of inventory that's hitting the market is higher now than the rest of the year. What you actually see is it's a little bit of reverse of what people expect, and we do see it in the data, is the average list price on a seasonal level, right? We see these spikes and valleys when we look at these list prices. And what ends up happening is it ends up being priced higher in the months with less inventory. Like we end up seeing price per square foot being higher in a month like December, January, and February than we do in a month like June or July, because there tends to be more inventory on the market, which allows people to have more choices. What ends up happening in those months where the inventory drops is if the buyer demand is strong, it actually creates more bidding wars. In months like now, where there's a lot of inventory on the market, your top, 1-2 listings are going to have a massive bidding war, but then the ones that aren't in that top 20%, won't have a bidding war. We're getting more things under agreement at asking or slightly below asking than we were a couple of months ago when inventory was just starved. So it's the other side of the equation where more supplies coming on, the demand stayed relatively strong, but that extra supply has made it so there's not as much going on in terms of bidding wars. No, yeah, no problem. And then it's one of those things where we just don't know what's going to happen, right? So summer is one thing. What'll happen going into the fall will be very telling about the market, for next year. But it's pretty normal for, this is the time of year that we try to get our buyers under contract, because there's just a lot more inventory. You can pick your battles and shoot your shots and try to find, some soft spots in the market. We were looking at buyer demand, right? So on a national level, this is what Forbes and Time and everyone else is talking about. Massachusetts went absolutely crazy, right? So again, the buyer demand was up 100%. What we're seeing in 2021 is it's it's higher than what it was in 2019. It tends to be trending very close to what it was last year, which is, an insanely competitive buyer's market. And then New Hampshire just went comical. So, 200% of what it was. Property in New Hampshire is still pretty untouchable. People who are looking for that $500,000 house or $400,000 single family house in Southern New Hampshire. I mean, even though inventory has come up, which, we're seeing as a benefit in some of these cities like Worcester and Lowell and Boston, it's not helping Southern New Hampshire at all. There's just such a pent up demand from the buyers that those medium priced houses are still very, very competitive with tons of bidding wars right now. If it survives the first weekend, there's probably something wrong with it, which is, unfortunate to say, because like most of the time that's not a true statement. But in Southern New Hampshire, like the market is starved for inventory still. So that's the data. I kind of ran through it quickly. We have a small group, so wanted to kind of get to the networking part. One of the nice things about, doing the virtual meetup is just a chance for people to talk to each other. When we weren't doing the in-person ones, right, this was a good way for people to network and get to know each other. Feel free to use the chat feature to say hi so I can introduce you, or to talk to each other if someone says something, that's interesting. Just asking, hey, what are you looking for in your next purchase? Introduce yourself, tell us a little bit about what you're looking for and why. So my name's John. I'm joining you from a 2-family here in Andover. What I'm looking for in my next purchase, I'm looking for a mixed use building within 45 minutes of Lowell. I want it to be close to the highway. I wanted to have the ability to put a billboard or some sort of a marketing sign on it. The reason being is, talking on some of the previous slides, our agents have grown exponentially. I need another office space, but I want to office hack, right? So we teach a lot of people how to house hack, how to live in a unit for free or at reduced rent. I want to do the same thing with my next real estate office. Buy a mixed use building, have the residential units upstairs or any other commercial units in the building pay for my office, so I can have a real estate office 45 minutes outside of Lowell for free. So that's what I'm looking for in my next purchase. Would anybody like to introduce themselves to the group and just kind of tell us what you're looking for in your next purchase?
Can you see me? Yeah, can you hear?
Hey, Gabriel.
Yeah. My name is Gabriel Perez. I'm currently living in Virginia, but I will move to Boston, hopefully between October, kind of around there. And I haven't purchased anything yet, but I'm looking forward to buying my first house hack.
Awesome. Thank you, Gabriel. And yeah, let me know when you're up in the area. We've been staying in contact. October is approaching rapidly, so looking forward to meeting you in person, man.
Yep. Likewise.
Christian, I think you said hi. Do you want to introduce yourself?
Yeah. Hi, I'm Chris Vanderloo. I'm joining you from I'm joining you from an apartment in Troy, New York. I'm looking for a 2 or 3 unit within half an hour of Lowell and half an hour of Lexington for my next purchase to move there, to live there, to house hack, hopefully by January. So
cool. Awesome. Welcome, Christian. We might have something coming up in Lowell that might be interesting. Like I said, I'm walking 6 units with a wholesaler on Saturday. It's a 4 and a 2. So if it makes sense. Most of the time we walk these things and we're like, hell no. But every once in a while we go.
I'll make sure to stay in contact.
Welcome, Chris. Thank you. Anyone else want to take a shot? It's a small group, this is the time to do it. Andrew. Hey buddy, how's it going? I think you're on mute.
Hey John, how's it going?
Good.
Yeah, so I'm currently house hacking a 3-family in Worcester. For my next purchase, I'm currently closing on the 3-family across the road. It was an off-market deal. And I want to buy more property, but I'm a little strapped for cash right now. But yeah, I had this weird situation with the seller where he scheduled the appraisal, then what didn't show, he was a no-show. So it just pushed back all my contingencies. So that's kind of where I stand right now with that opportunity.
That's a little weird.
Yeah. So
Thank you, Andrew, and good luck on the off market across the street. I mean, we talked about it a little bit. It sounds like a pretty good deal.
thank you.
I've got some, bourbon. I can wait you guys out. I'm not doing it.
I'll go.
All right,
So,
Josh.
my name's Josh Poitras. I'm from Lowell, grew up in Lowell, born in Lowell. Currently work as a Lowell firefighter. I also own 7 units between 2 buildings. Got a very good deal from another firefighter. Have a little bit of equity. I'm currently looking for my 3rd purchase. I house hacked the first 2 buildings. And now I'm either looking to refinance out of one and reuse my FHA or find a different, maybe beneficial strategy to purchase my 3rd one. And that's pretty much where I'm at right now. So
Thank you, Josh. We had an interesting experience with the Lowell Fire Department the other day. I'm not sure if that made it to you guys or not.
not to the trucks, but I saw it on your page, so I figured you had Big Julio there and Chief Norman maybe, and a couple of new guys that probably haven't met yet.
Yeah, a couple of new guys that did all the work.
Yeah, that's how it goes.
All right. Well, thank you everyone who introduced themselves. It's a small group, so I hope everyone can join. The in-person ones. We will keep the virtual one, going. So if you didn't get a chance to introduce yourself this week, we'll have one next month. The other thing I wanted to go over is, like I said, we've been working on this closing for a long time. We weren't really able to talk about it a whole lot due to some of the SEC things that we were in. We weren't able to advertise it. We weren't able to solicit. We weren't able to do a whole lot. But this has been a project that we're working on for well over a year. And we're finally, we closed on it yesterday. We're finally in a point where we can actually, answer questions and talk to people about it. The next couple of meetups, this will be a topic that I'll bring up just because we've been kind of skirting the issue over the last couple of months. Now we can finally, answer questions a little bit more directly. So this was a 132 unit site property in Lowell. We signed a PNS back in August of last year with actually a couple of members that I knew from this meetup. 2 of them are agents on my team. Another one was, one of the core people that started showing up with our first meetups in Lowell back in 2019. We had a guest speaker come on, actually our first virtual meetup last May. His name was Dan Crowley. He was an agency lender and got talking about, how the big guys take down some of these larger properties, right? So when you get over 10 million, when you get over a big property like that, they actually go back to Fannie and Freddie to do the loans. They call it agency financing. A lot of people think of FHA and Fannie and Freddie as your house hackers, your 3.5% down on your residential properties, but you actually can re-access those products again when you start getting into larger multifamily properties. They don't do mixed use, they don't do commercial, they just do residential properties, and it's pretty much sponsored by the government because they're some of these large properties, they just don't have the ability to find financing in some markets. Boston's a big market. We could find conventional financing, but the benefit of the agency financing is it was a much lower rate. It was a longer term. Most of the commercial lenders in our area would do a 5-year term at 4.5%. They did a 7-year term at 3.69%, which is less. And it's a non-recourse loan, which means assuming we do everything right, we didn't lie about anything, we didn't commit fraud, we don't do anything that would jeopardize credibility. The property doesn't sit on my personal debt balance sheet in terms of counting against me when I'm applying for other loans, or impacting my debt to income ratio when I'm applying to other loans, because even though I'm signing it as a guarantor, it's non-recourse, meaning, if something bad happens, it doesn't hit my personal accounts. The other thing about it is they gave us interest-only payments for 2 years. So for the first 2 years, while we're improving the building, while we're doing renovations, while we're driving revenue and value up, we have a much lower mortgage payment every single month, because of the first 2 years, we're just paying interest, which those types of loans are like reserved for your hard money lenders, your private lenders. Banks typically don't do interest only. They want you paying down the note a little bit, but the 2 years of interest only will allow us to inject more cash into the building up front, which was a huge advantage, besides the lower interest rate, besides the non-recourse loan, besides the longer term. The interest only was kind of the icing on the cake. We've been negotiating this for a very long time. The closing was scheduled in March and April and May and first week of June and second week of June, and it finally closed on June 15th at 3:45 p.m. And the Registry of Deeds, of course, had an electronic glitch and recorded it at 9 a.m. this morning. So, we closed, and I still had a pretty sleepless night after a year, because I was like, oh crap, like what's going to happen in the morning? But it did finally close. We did go on record. It is officially, our first syndication that is on the books. I've been at the property a lot over the last week, and we'll probably continue going to the property a lot for the foreseeable future, because it is something that now that we're closed, now it's something that we get to manage. Now it's something that we get to push to the point that we want it to be. A lot of you that have been attending these meetups, a lot of you that have been, part of the group, have probably seen some of this information before. But like I said, now that it's finally closed, we can share a little bit more information. We can answer questions a little bit more directly without worrying about getting our hands slapped very hard by the SEC.
Why does the SEC care about you discussing your investment? Why is it such a big concern?
Good question. So we raised this as a syndication. We ended up having 45 investors as part of this. We filed as and Todd's on the call, so you can correct me if I'm wrong. We filed as like a 305B, or he'll correct me if I'm wrong. But pretty much what we did is we filed the most stringent SEC guidelines for the syndication, so that we could take on up to 35 non-accredited investors. So a lot of times, if you're listening to podcasts, you're talking to people about syndication, they say, oh, you have to be accredited. You have to be accredited to join. A lot of the people in our network aren't accredited. So we filed the most stringent paperwork with the SEC, saying that we want the ability to accept up to 35 non-accredited investors. The trade-off is we're not allowed to advertise or solicit funds from anybody. So we can't go and knock on a door and say, hey, do you want to, you're an unaccredited investor that lives next to me. Would you want to invest in this? We had to do it in a way that people sought us out. We had to do it in a way that we reached out to people that we had more than 3 interactions with, or we've done prior deals with, and then everybody else would have to approach us. We weren't allowed to advertise or solicit in any way. Does that make sense? We pretty much tied our own hands behind our back in order to get the filing that we wanted, which is a little bit frustrating for the whole year, because we wanted to talk about it. And we kind of skirted the issue with social media and a bunch of other things. People knew we were working on the project, but we weren't really able to share the details, because that could have been considered soliciting.
So how, I guess, well, from my standpoint, why did the negotiations go so long? And then how did the negotiation go? I guess I just can't, I can't picture that going for so long. I'm just wondering how that all happened.
Yeah. So let me see what the next slide is. Yeah. Okay. So property highlights. So this is the property. It was built in 1980. One building was built in 1979. The other building was built in 1986. The current owner, or the owner as of Monday, not the current owner anymore, was an 83-year-old guy who built the property, owned over 1,000 units in this area, was down in Florida. This was his last apartment building in Massachusetts. Yeah, he's doing a couple condo projects down in Florida just because he can't sit still. He's been marketing this property on and off for 5 years. A lot of the bigger players I ran to have all been through the building. They all knew the owner. They all knew Nat Sergi. He was a very memorable guy. And the honest truth was he didn't want to sell the building. We met him in the height of COVID. We met him in April, and his property manager actually locked the leasing office, called him and said, I don't feel comfortable working with COVID, so I'm closing the office and taking unemployment. He at 83 years old with his wife had to fly up from Florida to manage the property every day. And that's when we met him. And so it was one of those things where he didn't want to sell the building. The circumstances put him in a situation where he actually entertained selling the building. We were planning to do a HUD loan originally, which would have been better terms. We would have been 95% LTV, so we would need a lot less money. There are a lot of benefits to going with HUD, but the problem with the HUD loan is it took 6 months just to get the financing lined up. So when we put under agreement in August, it took us from April to August to earn the guy's trust and come up with an offer that we agreed to. He wanted $20 million. We wanted to pay less. We ended up getting it for, a net 19.2. So we got it a little bit below, where it was. It appraised at 21,500,000. So we did pretty good. But it took us 4 months to get to the point where we had a signed PNS. And then we intentionally pegged the closing date in for March. And then it just kept dragging on. Due diligence took longer. Problems with HUD took longer. Problems with the getting everything together took longer. We ended up swapping lenders in February, and we went with the Freddie conventional loan instead of HUD. We had to come up with more money. We had to raise more funds. We had to start the syndication. But at that point, we already had our $21,500,000 appraisal. So it got a lot easier in February when we switched lenders to get everything moving in the right direction. It just still took, 4 months from that point to get it to closing. The thing is with properties of this size, it's just a lot more due diligence, a lot more going on. It was our first deal of this size. We spent a lot of time with structural engineers and environmental engineers and capital needs assessments and inspections and appraisals and sewer scopes and plumbing inspections and electrical inspections and pest control inspections and termites inspections and radon inspections. Like, we did everything, and all of those things just took time. Does that answer your question?
Yeah, that makes sense.
Took a while. Took longer than any of us thought it was going to take, including the seller and us and the bank. But the second bank, they were right on schedule.
I guess my second. Oh, I'm sorry. Go ahead, Andrew.
Oh, I apologize. I didn't mean to cut you off. Please go.
I was just going to say my second curiosity is about the numbers. So I hope you were about to get into that.
So as of Monday, I would have said, sorry, Chris, I can't. But as of today, I can't.
That's what I want to hear.
Andrew, did you have a question?
Yeah, I was just curious because, it sounds like your due diligence was like hundreds of thousands of dollars. Like, what would have happened if the deal fell through? You guys would have just been out that money?
Absolutely. Yep. That was our risk.
Just a lot of money for due diligence. That's all I'm saying.
Oh, no, it was like, I think so we were into it for $270,000. $150,000 of it would have been refundable if we didn't close as of April. In April, that money became hard. And so then we had the full $250,000 at risk. If we terminated the transaction prior to that, we were out anywhere between $40,000 when we started the transaction to that $120,000 that we were into it as of April. And then we signed up to lock in the other 150 to get us from April to June. And if June 15th came around or June 30th came around and we weren't able to close and the deal fell apart, one, we would have had to spend a lot of time and money and energy refunding all the funds that we raised, and two, we would have been out the $270,000 as a sunk cost.
Wow. I commend you. I commend you.
Which is why I didn't do it by myself, right? So that's why I had other people in on it. So I wasn't out $270,000. I was out a fourth of $270,000, which still would have sucked, but not as bad as being out $270,000.
That makes total sense.
I got a question for you, John.
Yep.
You said you had a 7-year loan from Fannie.
Yep.
So do you like get any anxiety over the fact that like in 7 years, like you're like, oh shit, like what's the rate is it gonna completely change? Is it like, or is this just kind of like the natural way of commercial investment and that's just, you're just comfortable with that? Or
Yeah, I'll go through the numbers a little bit more and then I'll answer it. We do have a plan, right, to minimize that risk. But I mean, that is the risk with all these types of loans is, you know, you lock in for a period and you can renew it. But I mean, the commercial lenders, I mean, they normally don't like locking in for longer than 5 years, regardless of the size. Like you could buy a $100,000 laundromat and they're still going to give you a 5-year loan because they're not going to want to lock those in long term. So it's just kind of, I mean, that's the world of commercial. But the way we structured the loan, we do have a little bit more protection than typical. So let me see. So this is the executive overview. So this was in part of our deck out to investors. We kind of ran through the numbers. 132 units. The thing about it is it had a confirmed 99% occupancy over the 12 months that we were in due diligence. The bank was able to document and confirm that the occupancy rate was 98%. So very high occupancy rate compared to what you would expect from a building of the size. And the reason being is because the rents, you know, our plan was to increase the rents 15 to 25%. Our current plan is to increase the rents 15 to 25%. So like the reason why the occupancy rate is so high is because it was literally the cheapest place to rent an apartment in the city of Lowell. And it's in a pretty good location, being right next to Chelmsford, right next to the highway. And so like they had waiting lists for these apartments because, you know, you can't find a 1-bedroom in Lowell for $1,100, let alone a 1-bedroom next to Chelmsford in Lowell for $1,100, which includes heat and hot water. So like anyone who's kind of like knew about Lowell and started seeing the numbers, you ran the numbers on it with commercial financing and it didn't look great because the rents were so low. You ran the numbers on it with HUD financing, the numbers looked awesome because you were extending the loan terms and the rates were low and you had the interest only period. And then with the Freddie loan, we had the appraisal in hand by the time we went to it. And so we were able to get it where we needed to be. The other interesting thing that kind of happened here is when we first toured the property with the owner, you know, renting 1 bedrooms at $1,100, 2 bedrooms at $1,250, we kind of, you know, mentioned like, oh, you know, we just rented a 2-bedroom around the corner for $1,500. And I mean, he kind of thought, you know, bullshit, like, you know, yeah, sure. And then over the course of the 12 months, every time an apartment went up, we saw him when we were getting the rent roll, we saw the ones that he was leasing go higher and higher and higher. And so they would, you know, $1,250, we saw him go to $1,300, we saw him go to $1,350, we saw him go to $1,450. The month before we closed in May, when we got the lease up, they continued, when we got the rent roll, they continued to lease the units. They were actually renting the 2 bedrooms on turnover at $1,550. And so we were actually able to, we identified that as an opportunity and the seller actually, you know, tested it for us and confirmed the majority of the units, you know, they didn't increase any rent, but the ones that were vacated, the ones that they turned over, they actually got the rents a little bit higher than what we were expecting to even win the unit renovations. Yes, the seller did us a huge favor. It was more he was trying to prove us wrong, and I think he wanted to call me and tell me I was an idiot, but it worked in our favor. So we put this together, and then we made an offering, right? So the offering was $65,000 for 1% common equity stake. So we were truly just selling off a piece of the property. You were entitled to the tax benefits. You were entitled to the the income, you're entitled to the equity appreciation, and you're also, entitled to the, if we lost money, you would get your share of the loss. We had significant reserves lined up, so we weren't ever expecting to do a capital call or require people to put in more money. But the way we set it up was we said, hey, like a lot of syndications set it up so the management team gets a bulk of the tax benefits, or they get a preferred equity stake, or they get something in it. We sold it off as a true equity stake. And so then anyone who bought in would get the full benefit of owning real estate, which one was simpler for us being our first syndication. It made more sense. And two, some of the high net worth people who wanted the tax benefits from real estate are looking forward to getting, sizable deductions that typically, don't flow that same way in a typical syndication. Shareholder distributions, we're planning to start those in January. So we got 6 months of stabilizing the asset and getting everything rolling. And then we would start, distributing funds in January. The goal would be to refinance or sell the building, in 5 to 7 years. So Josh, to your point around this is, we have a 7-year fixed loan, but we have no prepayment penalty after year 4. And so in, year 3.5, market stays pretty good. If we know the interest rate is pretty good, we could just do a refinance, lock in the interest rate in 4 years. If there's a spike in interest rates tomorrow, we could ride it out for 7 years. And hopefully that's a long enough time for the rates to come back to earth. The other benefit about it is the refinance would allow us to tap into the additional equity. So if we're going to increase rents, we're going to increase value, we should be able to refinance it, pull some capital back out for the investors, and then we can make the decision. If we needed to, we could sell it instead of refinancing it. But the way we limited that 7-year gun to our head is by buying down the prepayment penalty starting in year 4.
So you just said something like you're going to distribute back some of the equity to the initial investors around year 7, or the goal was?
Whenever we do finance, yeah.
So is that to get them their initial cash investment back, or are you like buying them out? Like, what's the ultimate goal? Is the ultimate goal just to keep this asset cash flowing, or the ultimate goal kind of like to grow out of it and get the assisting investors money back and take it on full time?
So it's a good question, right? So when we started this, we were looking at the HUD loan. It was a 35-year loan, fixed, no ability to get out of it, prior to year 10. And so the way we were looking at it is, we didn't want to sell the product to people as like, hey, like you're signing up for a 35-year marriage with us. And so the way we wanted to set it up was we were basically saying, our plan is to hold the property forever. That's the management team's plan. But we wanted to have a mechanism to get investors out after a reasonable amount of time if they want. And so the goal would be management team wants to hold it forever. Year 4 rolls around, we're able to refinance it. We have an appraisal in hand. We go back to the investor. We say, hey, do you want us to buy you out and consolidate ownership? Or do you want to stick in and get your share of the refinance refunded to you? And then hopefully, 20% of the investors want out. Great, we buy back those shares. Everybody's share is now worth 20% more because we're basically doing a share repurchase as a corporation. And then the 80% investors that want to stay in, they'll get their share of the equity left over from the refinance. And then we push the thing out another 5 to 7 years, and we do the same thing again, right? So we don't want people to say, the benefit of owning real estate is you can buy it, you can refinance it, you can sell it when you want. The downside of these longer term syndications is you're kind of locked in for the ride. The way we're trying to limit it is by setting up these checkpoints every 4 to 7 years, where people would have the ability to stay in and take their chips that are left over, or cash out entirely and move those funds to something else. Now, the risk is, 4 years from now comes around, 80% of the investors say, I want out. if we don't have enough funds from the refinance to buy them out and we can't raise the funds ourselves, that could force a sale where, you know, our intention is to hold the property long term, but if enough of the investors want out, you know, that could force us to sell the property instead of refinancing it. So we are giving up, you know, control over that by giving the investors the ability to choose, but we feel that that is the right thing to do. And then that way, you know, we will operate it as the investors see fit, but we would love to hold it forever.
Hey, John. So syndication at a high level. Sorry, I just wanted to get away from this. So Millennium Holding Group LLC, is this like a you know, a holding corporation for the purpose of purchasing this property that the investors share in, or?
No.
Okay.
So Millennium, so the only property that Millennium Holding Group owns right now is this property, but it's
Correct.
set
Okay.
up to hold multiple assets. So then there's two LLCs beneath Millennium Holding Group, which are dedicated to this property. One is the LLC where all the shares and the ownership of the property sits. The other one is the LLC where the managers hold control over the voting power. And then both of those roll into Millennium Holding Group. And so in theory, we've got, you know, Oak Residences Class A and Class B shares with two different LLCs. If we were to buy a different property tomorrow, we would have another two LLCs with Class A and Class B shares. They both roll up to Millennium Holding Group, but the two properties would be isolated from each other.
Okay. Okay. Interesting. Cool.
And that was the way the SEC attorney wanted everything set up, so that, you know, Millennium Holding Group would have the ability to buy more assets without the shareholders of Oak Residences having, you know, default ownership in other assets purchased by Millennium Holding Group.
Okay, that makes sense. So it's actually, so it's a structure of three companies essentially.
Mhm.
Okay.
Class
I didn't
A,
know that was how syndications worked. Actually, this is learning.
I don't think they all work the same way. So I mean, that was just the way based off of our vision. I think a lot of times what they'll do is, you know, they may not have the holding group. They may just do two LLCs. We wanted the
Mhm.
holding group and then the two LLCs.
Okay.
So this was our projected returns, right? So this was part of our, you know, what we were doing. You know, we were targeting a 23% internal rate of return. We were targeting a 12% cash on cash over the first 5 to 7 years, and then the whole period was the 5 to 7, you know, years, with the intention of giving people, you know, the option to cash out entirely or stick around, you know, when we perform that refinance. The detailed projections, well, I guess this was a change, right? So when we started with HUD, when we were doing the HUD loan, our IRR was actually a little bit lower. Due to the nature of HUD, we weren't able to start distributions to year 3. When we moved over to Fannie and Freddie loan in February, the IRR was actually a little bit higher because the owner had been increasing the rent for us. And so when we started getting the refreshed financials, we're starting getting the refreshed rent rolls, our IRR was actually higher because the seller kept improving the cash flow for us. And then because we went to Fannie and Freddie, we were able to start distributions a lot sooner. One of the things that we heard early on when we were trying to gain interest, we didn't actually raise any funds, we were trying to get interest, was starting distributions in year 3 really turned a lot of people off, right? You're locking in your money. Yeah, there's a good return in there, but you're not going to see a check from us for 3 years. When we moved over to Fannie and Freddie, that restriction got lifted. We were able to start distributions in 6 months, and that made a big change in terms of our ability to attract, you know, the people in our sphere that we knew that were on the fence. 2 of the major changes that happened was we were able to reduce our renovation scope by $2,000 to $3,000 per unit because he already started getting the target rent we wanted to get with the unit renovations. So when we saw him increasing the rents without doing any major renovations, we were able to downsize our unit renovation costs while keeping the projected rents the same, which had a huge impact on, you know, cash flow in this first couple of years. And then because the Freddie loan came with 2 years of interest only, we saved an additional $500,000 in cash flow by not paying down the mortgage. And so those two things, with the ability, the lifted restrictions on the distributions allowed us to, start distributions a lot sooner. Or plan to start distributions a lot sooner, right? We haven't started them yet because we closed on it yesterday, but those were two big changes that happened when we shift lenders that had a major impact on the financials. And $2,000 to $3,000 per unit, you're like, well, that doesn't seem like a whole lot, but now you multiply it by 132 units and it turns into real money. This was the projected schedule that we had. This was, this is our plan. This is what we're planning to do. The first 3 years, we're increasing value, we're increasing rents. We year one, we have that $21,400,000, market valuation that we're starting off with. We purchased the property for $20 million. We have our appraisal in hand at $21,500,000 now. The previous lender had it at $21,400,000. The new lender, gave us an extra $100,000 because, they liked us. So, and then as we increased the rents, we peg the value of the property to the cap rate that was in our appraisal. So when they did the appraisal, they projected the current cap rate at 6.8. Basically what we did is as we increased the rents, as we drove revenue up, as we, let the expenses rip with an extra 3% increase every year, we then just took the net income, multiplied it by the cap rate, and that's how we came up with the valuation. So even though we're taking the asset from, a tired 1980s building, we're putting granite in the units, we're updating them, we're increasing what we hope is the value of the asset, take it from a B- to a B+. We're keeping the cap rate constant as as an additional contingency. We're not assuming that the cap rate's going to get better. We're also not assuming the cap rate's going to get worse. We're just leaving it as, what we know today. Probably the biggest risk in this whole thing, and we talked about it, we talked about with investors, we were very open about it. The biggest risk in the whole thing is, the market opens up, cap rates go up, people are expecting a 7 or 8% cap rate. That impacts the value of the property and could prevent us from doing the refinance based off the value that we want. But the benefit of it, or I guess there's no downside to the cash flow. So even if the market changes, even if cap rates change and the cap rates get worse, in terms of value, the cash flow of the building won't change. And so we would be able to continue to do our distributions as planned. The first 2 years, we're expecting very low distributions, 5% cash on cash, and then that ramps up, quickly to double digits. The real value in the property is in that appreciation, right? We bought the property for technically $19,200,000. It appraised at $21,500,000. So we're starting off with a 26% return without doing anything. All we have to do is protect that return, continue to increase the cash flow, continue to increase the rents, and then assuming the cap rate stays constant, it has a pretty big impact on the valuation of the property. At the end of the day, it's just math. We have a huge Excel model behind the scenes that feeds all of this with a lot of different permutations. We ran this thing at a 6% cap rate, kind of like, getting a little bit psyched as, if we take it from a B- to a B+ and the cap rate actually compresses to a 6%, what does that do to the value? And it's absolutely insane. And then we ran it at a 7% cap rate and an 8% cap rate, kind of thinking worst case scenario type of a thing. And even at an 8% cap rate, right, we still have decent returns in terms of, mid-teens ROI over time for our investors. And so we felt very comfortable with it, kind of doing that stress test. If the cap rate gets better, great, like that's gravy. If the cap rate gets a lot worse, 8%, we still have a decent return. If the cap rate gets, much worse than 8%, something serious is going on in the market that we just have no control over. And so we would just ride it out until the market resets. And based off of the information we showed up above, right, when we were looking at the data from Boston and Lowell and Worcester, right, we saw it bottomed out in 2006, but most of the markets recovered within like a 7 to 10 year period. And so in theory, right, if we're going to a bottom out, which no one really thinks we're going into a bottom out right now, But if we do hit a bottom out, in theory, over the next 7 to 10 years, it should pretty much recover to where it is, assuming we follow the same market cycle.
Hey, John. So capitalization rate definition is your revenue over what you paid.
Correct. It doesn't assume any debt service. It's just, it's the total net income excluding debt service divided by the value of the property.
So a lower cap rate would be more beneficial than a higher cap rate.
Yep.
Which is,
so like Boston trades at like a 3 or 4% cap rate, which is why when you run numbers on them, you're like, well, I'm not signing up to lose money. And then when you get up to like northern New Hampshire, things are trading at a 10 cap rate. And you're like, oh shit, these things are printing money.
okay.
Right? So everyone's kind of like, oh, I want a 10 cap. Like that's kind of like the number that people are like, oh, I want a 10 cap. But that just means that the valuation of the property is less compared to the amount of money that it's bringing in.
Gotcha. Okay.
Does that make sense?
Yep.
The lower the cap rate, the higher the value is based off of the same amount of cash flow.
Okay.
So you mean like with a lower cash rate, you would have a property that costs more otherwise and would return the same revenue?
Correct. So
Yeah,
like, for
okay.
example, like if it's, if it brings in $1,000 a month and it's a 10 cap, right? Then it would be worth
Mhm.
$10,000. But if it brings in $1,000 a month and it's a 1 cap, then it would be worth $100,000.
Okay.
Does that make sense?
Cool. Yep.
We then did like an income summary. So we did a pro forma, we projected how this thing would play out. You can see down below, right? The rents, pretty funny, right? So when we started this thing, 2019, a 1-bedroom was renting for 1,100. They moved it up a little bit. You can see they moved it up quite a bit from the 2020 when we started this to the 2021 when we were running this thing from May through December, or when we were running this thing through the Q1. So they only increased it, $20 from 2019 to 2020, but towards the last half of 2020 into 2021, they increased the gross rents by like $40 a unit, which is pretty substantial over, a property of this size. Our goal is to increase the rents a little bit more, but those of you that know Lowell, right? Like we're not planning to increase these huge, right? A 2-bedroom for $1,491 with heat and hot water included is still well below market rent, even if it's in bad condition. We just rented a 2-bedroom in right near Bridge Street, which in my opinion, right, not as a real estate agent but as an investor, fair housing laws, my opinion, the area of Bridge Street is less desirable than where this property is, and we rented a 2-bedroom over there with heat and hot water included for $1,550. And so like we still think that our projections are on the conservative side. We have other properties in Lowell. We do a lot of business in Lowell. We know the markets pretty well. And so these were numbers that we were very comfortable with and are hoping to exceed. But these are the numbers that are being used in our projections, right? And so we try to make sure that the numbers that are being used are attainable. And this gives us a full, 6 months of 2021 plus 2 whole years in order to get the rents up to below market value. Which when you say it like that, it's like, oh, so like your goal is to spend $1 million renovating the property to bring the rents up to below market value. Yep, that's our goal.
But really in the long run, your rents are on the conservative side. So really you're probably targeting market value, right?
Probably.
Did I miss that?
It's a fair
Okay.
assessment.
All right. That's what I figured.
So this was the income. this was the, a summary of everything, running the mortgage and the expenses and everything else through to kind of show, how the net works out, and then running it with the cap rate, right? So assuming the property is worth the same amount, right? You have two options when you're doing these types of things: is you keep the cap rate constant and you say, all right, the cap rate determines value, or you keep the value constant and you let the cash flow determine cap rate. And so in the first example we did is we kept the cap rate constant and we let that determine the value. In this example, we did the opposite. We kept the value constant and we let the cap rate determine itself. And so assuming that it's still worth $21,400,000, we see that cap rate move up, right? We bought it at a 6.7, 6.8. If we leave the value alone, now it's a 7.3 cap. Then it's an 8.2 cap. And so we see the value go up quite a bit in terms of, we could sell it, bought it at a 6 cap, sell it at an 8 cap, and still make, $2 million isn't too bad. The one thing you'll see is, right, when you normally figure, when you do math on your own properties, when you see the mortgage rate, you're like, oh, the mortgage rate's going to stay constant, right? So year one, our mortgage rate is $575,000. Year two, our mortgage rate goes up. And then year three, it actually goes up again. And the reason being is because for the first 24 months, 2021, 6 months, unto 2024 or 2023, 6 months, we have an interest only period. And so after the end of our interest only period, our mortgage rate goes up quite a bit, but that extra, 24 months of interest only is allowing us to inject, $500,000 into the property that we didn't have before we changed loan types.
Wait, so why is there a disparity between year one and year two? The 574 and 708, you're paying the same amount. Are you paying the same amount in just interest payments in the first 2 years?
In the first 2 years. So the first half of 2021 and the second half of 2021 and the first half of year two, we have interest only. The second half of year two, we'll be paying interest and principal.
Okay, that makes sense.
So the total mortgage rate is going to be $808,000, which is what these numbers are. But we're actually not going to start paying $808,000 in mortgage principal and interest until year three.
Okay, cool.
Which is a little bit odd, right? Because we're buying it mid-year, and so the 24 months also spans mid-year. One thing is I threw at the bottom there, debt service coverage ratio. So when you start going into the commercial world, the debt service coverage ratio is everything, right? So you show up with a cash on cash return, they say, cool. You show up with a cap rate, they say, all right, cool. But what the banks really care about, they care about the debt service coverage ratio. So assuming, they want to know that you're going to be able to bring in enough money to service the debt. They normally target, 1.25 to 1.3 debt service coverage ratio. I mean, the way the numbers are running on this, the debt service coverage ratio is comically high. But that's just because we have an interest only period that's riding out for the first couple of years. And then also because, we are starting in a position of pretty positive cash flow. And typically when they do the debt service coverage ratio, they exclude your capital expenditure budget, which, in our case is $1 million of capital expenditures that go into the property first couple of years. And so when you look at it from the lens of the bank and the underwriters, excluding the CapEx stuff, and targeting the interest only periods, the debt service coverage ratio gets pretty comical, which is how we were able to negotiate the rate down, negotiate the 2 years of interest only, because the debt service coverage ratio was so strong. We were able to get much better loan products than, is typically off the shelf. When you're, if you're going to a commercial bank, even if it's a 5 unit or a 6 unit, like small stuff, It doesn't matter. The commercial bank wants to, you're going to hand them your bigger pockets calculator, which I still do. I do the bigger pockets calculator. I run everything through. I hand them the sheet. They'll flip to the second page and they'll look at the debt service coverage ratio. They'll look at my expenses and make sure I put in 25% for like maintenance, CapEx, property management, and vacancy. But then all they really care about is they care about that debt service coverage ratio. Will the bank get paid? If the answer is yes, great, let's go. If the answer is no, it doesn't matter where the property is or how good of a lender you are or how good of a borrower you are or how good the curb appeal looks or what the appraised value is. If the debt service coverage ratio doesn't cover the bank's note, they won't write the product. And that's something that, we just learn over time by doing it, talking to them. They don't care about any of the other numbers. All they care about is the debt service coverage ratio. And then, final is when we started this, we thought we needed somewhere between 4.8 and $5.2 million to close. The week before closing, they eliminated what was lovingly referred to as the COVID reserve, which was 9 months of additional reserves to cover the property in case bad things happen. So when COVID hit, Fannie and Freddie stayed open. But what they did is they penalized all the loans by saying, hey, uncertain times, you need to set up a 9-month COVID reserve that can't be touched. We got word back in May that they were trying to eliminate the COVID reserve. So we actually stopped fundraising a little bit earlier than we intended. And we were a little bit of lucky, a little bit of timing. They eliminated the COVID reserve entirely the week before. We had a opinion in to try to eliminate it earlier, but they actually took it out of all loans about a week before our closing. And so we went from needing 4.8 to 5.2 to actually needing 4.4 million to close. We ended up raising, almost 4.9 million. And so we were able to close with a pretty good reserve budget, kind of sitting behind the scenes, so that we actually could move the renovations up a little bit sooner than the original model intended, do renovations quicker, and try to increase the rents faster, because we were able to close with less money and keep a pretty healthy reserve behind the scenes that we can actually access.
What's the reserve without the COVID that they wanted you to have?
It's shocking, but technically the reserve is 0.
And they just came out of nowhere and was like, we want to see 9 months.
9 months locked away that you can't touch.
Right.
It's not 9 months in your bank. It's 9 months in their bank that you get to wave at and say, hi, money. I hope you get released to me in 9 months.
That's crazy.
Hey, John, just quick question. With the 600 reserves, are you required to keep that in a bank, or could you invest a portion of it in stocks? Or I'm just curious.
So interesting question, Andrew. So we figured this out under the gun because this was our first indication. When you're under $10 million, the typical loan paperwork that you're submitting is fine. Technically, the money that's sitting in your account, you could use for whatever you want. Granted, if you use it in a way that doesn't benefit your investors could file a class action suit against you. But in theory, you could take that money and you could literally buy the property next door and say, now this laundromat is part of the property. When you're over $10 million, they incorporate this thing called an SPE addendum. And basically that's a special purpose entity. And what they did is they pretty much said, any money that comes from this property, any reserves that are generated, from the closing, from the capital gains, from all that, can only be used on this property. If we wanted to buy the vacant trailer next door for $100,000, we couldn't do it in this entity. We'd have to either do it under the parent entity, Millennium Holding Group, or form a new entity to buy it. What they pretty much did is they pretty much restricted, saying, this is a special purpose entity. The sole purpose of the raise, the sole purpose of its operations is for this property. So you literally can't do anything that doesn't benefit this property. So like we couldn't invest in stock. We couldn't purchase more land next door. We couldn't do those types of things. Our options are we can either reinvest it in the property to improve it, or we can release it to shareholders. Which was our intention anyways, right? We wouldn't want to be like, hey guys, we just bought a whole bunch of Dogecoin, like fingers crossed. We wouldn't want to do that. But the way that they structure the paperwork is we legally can't do that.
It just hurts to see 600,000 in cash just sitting losing value. No.
We'll put it to work pretty quickly, I promise.
I was seconds away from making the Dogecoin joke. Come on, man.
If it was under $10 million, we could have.
Or you could always like build a restaurant on the property and just get another business, right?
Yeah. Yeah, we could do stuff like that. But I mean, it's a healthy reserve. We're hoping, we can beat expectations. And I think we'll be in pretty good shape. So I think that's it. Does anybody have any questions? Anything, any questions for the group? Any questions about what I talked about? Anything you'd like to ask other participants, or anything that you're just kind of like you hop on Google at 2:00 in the morning and try to find the answer on it, and you're like, I don't know if that's right, or I might be the only one that does that. But anything like that people want to talk about?
Can you talk about agent stuff or no?
Mhm.
Right now? So you taking on more agents or what?
So my answer is always the same, right? So I don't recruit agents. I spend $0 recruiting agents or on marketing. But if the right person says, hey, I'd like to join, I'm always open for a conversation. The 16 agents that we've hired, right? They've all knocked on the door. They're all asked to join. I've said no to agents, but there's always room for the right ones.
Word.
But I have same restrictions for everyone. They either have to own investment properties or agree to buy an investment property within 12 months of joining, because I'm just a big component of Eat What You Preach. We work primarily with investors. So like if you want to work on the team, you want to work with investors, you have to be able to walk a property and look someone in the eye and say, hey, I would buy this property. Or be like, hey, dude, like, let's get the fuck out of here. And you only get to do that if you know what you're looking at, right? You talk to an agent and they're like, oh, no big deal. We'll just evict the tenant on the 3rd floor and you'll be fine. But now that you're an investor, you're like, that tenant on the 3rd floor has 3 kids and it's the middle of the winter. Not going to be an easy eviction, right? But you only know that by living through it and caring about those types of things.
Got another one for you. Speaking of eviction, you have anything in eviction court right now or no?
We've actually been very lucky. The only one I have in eviction court right now is in the state of New Hampshire.
Nice.
And they paid me all the back due rent to stop the eviction.
That's how you do it.
The rest of them, we've had tenants that we needed to get out. We've had tenants that we've gotten out of buildings. But normally, people are like, the cash for keys concept, it's underutilized, and like it cost me $1,000 to do an eviction. So normally what I'll do is, we'll talk to the tenant and we'll say, hey, listen, like, we need the unit. It's got nothing to do with the fact that you didn't pay rent last month. We need the unit for renovations. We need the unit for something else. I'll give you $1,000 in moving expenses if you're out by the end of the month. Sometimes it's not the end of the month. Sometimes it's the 5th of the month or the 10th of the month. But almost always, they're looking for their $1,000 to get out.
I actually offered a kid 2,000 and he looked me in the face and said no.
That's great.
He's been living free in the unit for 10 months with me and 6 months with the last owner.
Oh, geez.
And eviction court's like killing people.
It is, but you can apply for RCAP. Have you done that?
No, what's that?
So apply for RCAP, because if you go to eviction court, they're gonna make you apply to RCAP anyways. But RCAP will get them paid up for almost an entire year to stop an eviction.
Let's just stop it. Yeah, no, almost it.
No, but I mean, like you'll get paid up and then he doesn't pay the next month, then you start it up again. But you'll get 8 months of back due rent paid in full in a check.
Even though I already have him on the, I already have a court date to kick him out like next month. So
Yeah, but on the court date, they're gonna tell you to file with RCAP.
really,
That's what they're gonna do.
yeah. All right. We'll see what happens.
Yep. Anything else? Anybody have any questions?
So is that usually your strategy after like 1 month of them not paying? You just offer cash for keys, usually around $1,000.
Normally, we'll do something like that. We'll try to terminate their lease. We'll try to get them to leave. We'll try to ask them, hey, what's going on? Are you guys looking for another place? And if they say something that makes us think that they're not going to be paying, or we can't get money from the state, that's normally what we would do. Is we'd offer them the same amount of money it would cost me to start the eviction process just to get out. But most of the time, right? Most of the time we've done that under circumstances that we're actually selling the building and we needed to get them out to for the buyer to qualify for the loan. Most of the units that we've had to vacate over the last 12 months were because we were selling the building and we were trying to get an FHA buyer to purchase the property. I think there's only 2 times that we did it instead of doing an eviction.
Cool. Thank you.
No problem. I mean, most of the time tenants don't want to be evicted, right? If they end up in court, it's very easy to do a background check. It costs you what? Anyone using Cozy costs you like $25 to do a background check. It's very easy to do a background check. And so like if they get evicted, the chance of them finding another apartment anytime soon is very slim. And so most of the time, you present them with the option, you tell them, hey, like this is the deal. We normally try to approach it from an area of we need the apartment type of a thing. But then on the back end, we'll say, if we have to evict you, we'll take it to small claim court. We'll make sure that it sticks. We'll make sure it hits your credit. We'll make sure it goes the full process. And so then they're kind of looking at it as, do I take my 1 month free rent and $1,000, or do I gamble under the circumstance that they somehow get this through the courts and now I'm not able to find an apartment?
Well, the question is, the next landlord, when he calls you, what do you say about this and his tenant?
They don't. I mean, they don't list us as references.
Oh, okay.
They just won't, right? I mean, it's up to the landlord to look and be like, oh, where are you moving from? And look to see that, oh, I'm actually calling, a member of Piece of the Earth LLC or a member of Driftwood Mountain Realty or a member of one of the LLCs. But I mean, most of the time, if they're going to, a less than desirable apartment in a less than desirable neighborhood, I'm assuming the landlord's not doing that check.
I just had this kid. He's basically using the apartment as a drug place to do drugs, and this is a kid offered $2,000. So I've been dinging his credit with landlordcreditbureau.com.
Yep.
And now I'm looking to bring him to small claims after. So.
And then that'll make it so he can't get an apartment anywhere. But I mean, a lot of times you have that conversation with them up front. They tell you to fuck off. Couple days later, you get the phone call of, hey, I'm looking for a place. I need that $1,000. Okay.
Hi, John. John?
Yep.
Hi. I'm curious. Can you talk more about negotiation strategies, like when you lock up a property, like at market price? How do you go about looking for a discount or things like that?
Yeah, so I mean, so normally when we lock something up, we intend to pay that price. But normally we'll put some sort of language in there around the things that we don't know, right? So if you go to a 3 unit and you get 2 units, but you don't get into the third unit, we would say something like, offer, we're offering you $200,000. Offer is contingent on the assumption that you agree in the same condition as the other two. Our offer is contingent on, us assuming that there's $5,000 worth of repairs that need to be done. And then if we walk it, find out that it's $15,000, then we point back to the contract and say, we assumed 5, there's 15. So how are we going to bridge the 10 grand? Or, if we put under contract with an inspection contingency, we then we walk the property, we say, hey, listen, like, there's $15,000 worth of expenses here. Yeah, us being a landlord, we were expecting to pay 5 or whatever. But, what are you guys planning to do to help us?
Are you hungry?
A lot of the times where we got in some pretty big discounts where
You
we
need some
found
food?
major problems with the property.
You're not hungry?
The wall needs to be replaced, or there's something wrong with the fire smoke inspection system. Like normally the ones that we got really big discounts on were because we found really big things wrong with the property during due diligence. And it's just one of those things where you have to replace the entire electrical on an 8-unit building. That's going to cost you $30,000 that you weren't expecting to do. So you kind of get to the point where you're like, well, you're either giving me a $30,000 credit or I'm backing out of the contract. Sometimes, like I said in the previous slides, sometimes we back out of the contract and the deal doesn't go through. The ones that are on our books are the ones where we were able to figure out an arrangement that made sense. And sometimes, like, $30,000 of electrical, we did have to update that relatively quickly. But I had one electrician come out and quote me $30,000. I used that for negotiations. When I was going to do it, I brought 3 electricians out. 2 of them quoted me $30,000. One of them quoted me $25,000. And we were able to talk them down to $22,000. And so I got a $30,000 credit for something that we were able to get done for $8,000 less. Does that make sense?
Yeah, it does. I haven't done it yet, so because we're doing an inspection tomorrow for a duplex in Billerica, but we already know that one unit, the upper unit, is gutted. So I'm just trying to figure out how to go about it once we get the inspection and once we get a GC, kind of do a scope of work of how much that's going to cost to finish it.
And so, like, so if you go into it saying like, hey, to finish out that unit, I'm thinking $20,000. Then the GC comes through and they're like, well, all your plumbing is screwed up. So you got to redo all the plumbing. So $20,000 plus $10,000 of plumbing. So then you go back and you say, hey, I knew about the 20. I didn't know about the 10. So like, what are you going to do about the 10? You can't go back and say like, well, oh, we didn't know the whole unit was gutted. I thought we weren't going to spend any money there. What you can do is you can target the things you didn't know. I didn't know you didn't pull a plumbing permit. I didn't know you moved the bathroom without telling the building inspector that you were moving the bathroom. And so these are the things I didn't know. And this is the value associated with those things.
All right. But yeah, makes sense. What do you do about the difference?
I'm sorry, Eric, you broke up there. I didn't hear the question.
Is there a better way to just ask for a discount on the purchase price, or can you do some sort of a seller credit back? Or sorry, what do you do about the difference?
So normally the seller credit
just to ask for a purchase price discount, or can you do a
Yeah, so the seller credit is worth a lot more to you, but the seller credit and the purchase price reduction is worth the exact same to the seller. So if you think about the math, right? So if you buy $100,000 property, if you take 10% off the property and you're putting 25% down, you reduce the price by 10 grand, but you only saved $2,500 out of the amount of money you were putting down. If
Right,
you
right.
take that 10 grand as a seller credit, you could save dollar for dollar on that 10 grand. So instead of saving $2,500 by $10,000 price reduction, you're saving $10,000 from your closing costs.
Got it. Because you're basically sharing that with the mortgage,
Yeah.
whatever you're having a discounted purchase price. All right, that makes sense. So it sounds like it's better to get a seller's credit than to have a purchase price discount if it's the same amount.
Absolutely. And so we bought the syndicated property for $20 million with an $830,000 seller credit.
Wow. That's great.
But
Yeah,
it worked a lot better than buying it for 19,170,000 because we were able to save a lot of money on the closing costs.
is there a limit for the seller's credit, like a percentage of the purchase price?
On the residential side, it's 3%.
3%.
On the commercial side, it's whatever you can get the bank to say that makes sense.
Ah, all right. I'll learn something today.
Pre-COVID, I got a $60,000 seller credit on a $360,000 house.
All right. Wow.
But it wasn't my first deal, and I was able to explain what we're going to do with that money. But like, there's no limit when you go on the commercial side, as long as the commercial bank agrees and the appraisal supports it. You know, we bought it for 360. We got a $60,000 closing credit, and it appraised at 410,000. And so like, it all came together, and the bank said, okay, right? But if it appraised at 320,000, you better believe the bank was going to call bullshit on my closing credit. Any other questions? I love closing credits. Like whenever I get a chance, we try to negotiate for closing credits because it's like it changes your cash on cash return like overnight, and it has the exact same impact on the seller. All right. So last slide is just my information, so thank you everybody for coming. If you have any feedback about tonight's event, please let me know. We had a light attendance this week, which is okay, right? We just launched the Lowell meetup. We had about, 60 people show up for that. We have the Nashville one next week. The in-person ones, frankly, a lot more fun than the virtual ones, but we'll keep the virtual one going because I have a feeling, when we get into the colder months, when we start having, weather to contend to, I have a feeling this one will ramp back up. But if you get a chance to attend the Nashville one next week, or we have the Lowell one slotted back in for July 8th, you should be getting invites for that if you're on our mailer list. If you're not on our mailer list and you want to be added, just shoot me an email or shoot me a text with your information. We'll get you added. And we'll have hopefully 3 events going every single month: Lowell, virtual, and Nashua. And we're looking to add another event in Worcester, and hopefully another event closer to Boston, maybe in like the Burlington, Waltham area, but we just haven't found the right venue yet.
Thank you, John.
Thank you, everybody. And if anybody has a good venue in the Worcester, Burlington area, please let me know.
Thanks, John.
John, thank you.
I'll start researching bars.
Yeah, I mean, what are you doing, Ian? Like, come on.
I was down in Wales today.
Jeez. Like Wales, England, or somewhere else?
Like Wales, Massachusetts.
I didn't know that was a place.
I didn't either, but it's by a lake.
All right.
See you, John.
See ya. Thank you, everybody.
Good night.